everybody thinks they're a genius in the bull market. I thought I was clever back then. Of course I wasn't. I was a lucky kid, right time, right place. And I was reading pretty much every trading book I could get hold of. And it took me also many years to realize that very few of the books were actually useful in any way. My personal opinion has been for the last 5-6 years that this bull market has lasted way too long. It's going to crash any moment. I don't trade on my views, I trade on my math. Opinions are not always good. It's never a matter of the best possible rules, the best possible system, the most profit. That's not how you build a professional trading strategy. First, you need to figure out what are you looking for. To make money is not an answer. People are saying strategies only work because everybody follows it, or they say because nobody knows about it. And both can't be true. I used to build very complicated things like 20 years ago. The older I get, the more I realize that simplicity gets the job done.
Andreas Clenow is a Zurich-based fund manager, quantitative trader, entrepreneur, and best-selling author known for translating systematic strategies into practical frameworks. He currently serves as CIO of a family office overseeing multiple investment programs and managing a 9-figure asset base. Before stepping into the family office role, he built a career that spans both technology and finance. He started programming at a young age, studied finance at Gothenburg School of Economics, and founded an IT company in the 1990s before moving into the financial sector. He later joined Reuters, led a Nordic consulting division, working with banks and asset managers, and eventually left the corporate life to launch and run his own hedge fund business. Outside of portfolio management, he has continued to build products and research platforms for systematic investors, including Clenow Research and now the Hush app. Beyond that, Andreas is popular among traders and investors for his books Following the Trend, Stocks on the Move, and Trading Role. He's also written a fictional novel titled A Most Private Bank. Thank you, Andreas, for taking the time to talk to us. As a systematic trader myself, your books have had an immense impact on how I design trading and investing strategies today. Thank you again, and with that, let's get started.
Thank you for having me. Great to be here.
I was reading about you and listening to some of your podcasts to get a better understanding, and one of the things which I figured out was you started with computer science at a very young age. What got you to computers? What got you interested in computers at a young age? And what were you coding at that point of time?
Dangerous question. I guess the answer to that is beyond the statute of limitation at this point, so I could elaborate on that. I think I started using computers when I was about 8 or 9 years old. Obviously, the big thing back then was how do you get hold of more games? Which involved obviously, cracking games and figuring out how to get more games without breaking your budget as an 8-year-old. So I guess that's how I first got into computers back then. For those of you old enough to remember, even to start a game back then required a little bit of knowledge about computers. So it was a natural thing. You had to figure out about computers. Nowadays, of course, you press a button and the game starts. That was not the way things worked back then. I was part of the young underground computer world back then, figuring out how to bypass copy protection on games, how to play games, how to get them started. And, you learn a lot from these things. This was, let me see. This is, sometime in the 80s, I suppose, I started with these things.
Floppy disk and CD-ROM days.
It was way before CD-ROMs. Originally it was cassettes. So you had the actual cassettes. I'm guessing that a large part of this audience have no idea what I'm talking about. After that, you advanced to the big leagues, the 525-inch floppy disks. The big soft bendable disks. The ones where you can actually take a pair of scissors and cut a little square in one side of it, and suddenly you have double capacity because you took a pair of scissors to a disk. Hard to explain those days to people these days.
Good one. How did markets happen after that?
Markets, I guess I got interested in finance during university, or probably quite early, even quite a little bit earlier than that. As so many people my age, I would blame the movie Wall Street, 1986, not the other ones with similar names coming later. The movie that Oliver Stone made to discourage people from finance and explain how evil finance is. And it got a whole generation of people like me to join finance instead, because we all misunderstood the movie and we saw Gordon Gekko as a big hero. So I guess I started getting interested in finance around there. Like movie came out 86. I guess I probably saw it 88, 89, something like that, and decided to go that path. Combination of the two things, of course, was quite natural. Once I had some education in finance, and I had already some skills on the IT side, it was quite natural thing to combine the two and figure out a way to have benefit of knowing both sides.
Got it. But what were your sense of markets? What were you reading at that time? And what was your understanding of how markets work at that point of time?
Well, back then, I would say I was extremely good at the markets back then. I was essentially just buying tech stocks before the reports and making money. Clearly, like everybody else back then, I thought I was clever until I realized that it took me some years to realize that my brilliant strategy of beating the market was based on buy stocks in the bull market and hope for the best. Everybody was making money back then. It was sheer dumb luck. I started investing in a massive bull market in the .com boom. So of course it's fun when you start in that kind of environment and it looks so easy. Then it's fun, and like everybody else, everybody thinks they're a genius in the bull market, and I thought I was clever back then. Of course I wasn't. I was a lucky kid. Right time, right place. But I was reading back then. I was reading pretty much every trading book I could get hold of. I was reading a lot of books back then. It took me also many years to realize that very few of the books were actually useful in any way. But I read all the usual names. Whatever books you're thinking of, I probably read them back then.
Anything in particular that stood out and that kind of helped you? In retrospect, if you think who made sense?
Let me see. I always enjoyed. I liked the Market Wizards book, of course. There was a few of them. In the end, did I find any use for it? Not really. It's more inspirational stories. Jack is a great author, of course. I read everything that Jack wrote. In the end, I probably had much more help of reading more technical books, things that help me figure things out on how to actually do stuff. Too many trading books. Many trading books are more inspirational stories. It's great for like a feel-good story, but they don't really help you with anything really practical. Now, I read a lot of these things. I would say some books that taught me a lot about finance. Obviously, Liar's Poker was a brilliant book back then. There are a few books like that. It's not going to tell you anything directly about trading. It tells you about the finance industry. So that's a brilliant book. It doesn't pretend to teach you anything about how the markets work. It teaches you how the finance industry works.
At that point of time, I understand you were discretionary as an investor or trader. And, how did this whole transition from being discretionary to systematic happen?
I think even back then I was doing a lot of attempt at systematic trading. I remember I had a bunch of models which looked great at the time. Obviously, like everybody else at the time, I did the stupid math on, if you have, say you have a great month and you take crazy risk, you don't even realize how much crazy risk you take. And suddenly you have like a 50% plus month, which of course is unsustainable. But like everybody else, I did the funny math of what happens if I compounded that for the next, 10 years. And, you start calculating on when you buy your own island and all this nonsense. Everybody does this when you're young and naive. You start compounding the last month or so. No, I was doing some things back then. I was even, I remember back in the 90s, I even once built a real-time point and figure plotter in Excel VBA, which was, I would say for early 90s, it was probably quite advanced. It didn't make me any money in the end, but it was a fun little project.
Got it. But how did this transition happen? At what point, you were a discretionary investor or trader and then thought, okay, it makes more sense to kind of code something or backtest a logic. How did that transition happen?
I think I started becoming more skeptic about things. I saw a lot of stuff that I doubted, especially things I read about in books or online. I saw a lot of things that didn't make sense to me. I tried to quantify it, and I realized many of the, I would say, the more outlandish and ridiculous things.
Like?
Say if somebody tells you that the universe is based on predictable waves, where it's like 5 waves up and 3 waves down, and you divide
Elliott wave or something like that, yeah.
Exactly, and you divide certain numbers by each other, and you get these funny ratios based on a rabbit counting mathematician in Venice, was it Florence, a few hundred years ago. It's ridiculous. It's some sort of pseudo-religious nonsense. If you believe in these things, then go join a cult or something. It's not finance. I started trying to quantify all these kind of things. I started looking for ways of Can we quantify? Can we quantify anything about Elliott waves or Fibonacci numbers? And by the way, my view on those things are clear that nobody in the actual finance industry takes those kind of things seriously. That these are like fairy tales for hobby investors. And you very quickly realize that none of these things are even quantifiable. If you try to define them as math, you can't, which is why people can always claim that they work, because they can always say your wave count was wrong. Now, then I started trying to figure out what does work, and I realized that as a general principle, the simpler things tend to be more stable. So I started building fairly simple things. Look at my original background in the hedge fund industry about the managed future space. It's not very complex math. The math behind it is not very complex. You just need to build your models and test your models and build confidence in them. And this can be done by most people.
So, which was largely trend following. Is that how you got started?
Yes, exactly. That was my first type of investment strategy on the professional side. Once I left my corporate gig back in Geneva back in the days, I had a funny title. What was I called? I was Global Head of Commodities and Equities Analytics, something like that.
Oh, that's a great title to have.
Oh, yeah, sure. Corporations are great at giving you good titles. That's a good way of avoiding giving you more money. Give you a better title instead. That's how large companies often work. But anyway, that was fun for a while, but I felt I had to get out of there. So I launched my first fund back in 2005, 2006, around there somewhere, in the trend following future space. That's when I started considering writing a book, mostly because the first thing I did when I started the fund was I started buying every book I could find on the topic of managed futures. And I quickly realized that it's very clear, if you come from the industry, that almost none of them have any background in the industry. What they're talking about doesn't make any sense, and they're missing all kinds of details that are very obvious to people who have been there and done that. So my impression was most books about that topic were written by people who don't know more than their readers. So I figured I'll try to write a very simple to the point book explaining how the industry works, and that's the one that turned out to be, let me see, over there somewhere.
Yeah, I can see that. Though both the titles look very similar image, but then I can see that. That's also one of the books I read and which informed me about trend following in a serious way. So thank you for writing the book. 2005, which means within a few years of you starting your fund, you experienced the great, financial, crash of.
Yep.
So how was that? How was that experience?
Oh, that was interesting. It's one of those years. If you look at a track record or even a back test for the managed future space, forget about the other parts of the industry, but just for the managed future space, it's going to look like this was the greatest year ever. Yeah, we had great results that year. I mean,
because of crisis alpha sort of a thing.
Exactly. Everybody else was suffering. Stock market lost half value and so on. The managed future space did extremely well, but still, anybody who was on that side, on the sharp end of that business that year, will have PTSD feelings just hearing the word 2008. Yes, we had the greatest year ever. We had the most profitable year in the history of the industry, but it was not a fun year. This was a year where the stress level was extreme. Anybody who has any sort of, anybody who understands financial responsibility would have overridden their systems to decrease risk that year, because you had massive swings. Once you start seeing 15, 20% on the entire fund swings per day, you decrease risk fast. Yeah, you would have made more money if you didn't decrease, but that's insane. You don't take the kind of risk. Most models were not designed for the kind of volatility we saw there. And of course, the bigger problem was in the managed future space, you always have a large amount of cash on hand. Now cash management is a large part of the field because you only use usually 10, 15%, maybe 20 if you're aggressive in terms of margin. Now you need to do something with the rest, which usually means you need to safeguard it somewhere. Obviously, you don't keep hundreds of millions in cash in a bank account. That can blow up in a day. But where do you keep it? And if you need it pretty soon, you need short durations. This became a ridiculous game of, in the afternoon every day, you have to analyze which of the major investment banks in the world are least likely to blow up in the next 24 hours. So imagine you spending a couple of hours every afternoon trying to figure out, is Deutsche Bank or is it going to be Goldman Sachs or JP Morgan? Who is most likely or who is least likely to go bankrupt in 24 hours? And now you do overnight depots with those banks. I mean, today that sounds absurd, but that's what you had to do for a couple of months or for month and a half or something like that. So that was pretty extreme.
But did you also have to adjust your positions based on volatility?
Yeah, of course. I mean, my models, like many others, were not at all designed for this level of activity in the markets. So you have to override it. I mean, this whole, there's a lot of mantras and a lot of say platitudes in the business about always do this, never do this. You can't act like that. Sometimes the markets will remind you that they will surprise you and do something that you did not prepare for. Your model, your math is not prepared for. In that case, you need to take action. Especially if you have a responsibility for a large amount of money for other people, you need to act responsibly. My models were originally not adapted to this extreme level of volatility. We've never seen anything like that in history before, so you need to take action. You need to adapt. But even then, obviously, I decreased risk a lot from default, as did almost everybody out there. But yeah, it was a tough year. It was a tough year. After that, me and I guess everybody else started designing models for extreme scenarios that we couldn't imagine. What if something extreme happens? But it's an interesting year, that's for sure.
So one of the things which I've observed, Andreas, is, as investors, the experiences which we have in the initial periods of our careers kind of informs how we look at the markets. Do you think 2008 was one such event for you where, which continues to inform your way of looking at the market?
I think it's even earlier, to be honest. I think 2001 to 2003 has very much formed my view of the world. That's something interesting I see nowadays, that many people who have not been in the market very long, they believe that stocks will always go up, markets will always go up, and a dip should be bought.
In India, a lot of investors came post-COVID. So people who've been like me, the older people who've been there earlier, we kind of look at them and, we tell them, you've not seen what a market is like, because they've never seen a recession or a downturn. They've only seen markets going up. So I think you're talking about, people who recently come into the markets.
Yeah, I mean, recently we now have the longest running bull market in 2 generations. I mean, there is a reason that I trade systematically and not on my opinions, because my personal opinion has been for the last 5-6 years that this bull market has lasted way too long. It's going to crash any moment. But don't take my word for it, because if I was good at predicting this, I would do that for a living. So yeah, I believe the market's going to crash soon, but I've been saying that for so many years. I've been wrong so far. I don't trade on my views. I trade on my math, and my math has been long, and my math has been loading up risk. So yeah.
Yeah, got it.
Opinions are not always good.
Yes. And do you think it's fundamentally quantitative easing changed the way markets work? Do you think that has had an effect?
Yeah, obviously that had an effect for some years, but do these things have an impact over decades? Probably not. I mean, we've seen various patterns of financial policy, fiscal monetary policy from both Europe and the US in the last few decades. Yeah, it changes. Some structural things are happening. Most of it on where the interest rates are and which direction they're moving. I mean, take an extreme example. The one reason why the managed futures game was so fun for so many years was that we had a very unique situation where interests, we're talking American interest because that's primarily what the game is, or at least was, interests were very, very high and slowly moving down. And in that environment, with no particular shock, this was like 80s and 90s. Well, first you made a lot of money from interest moving down. So you made a lot of money from the bonds going up in price. Inverse relationship people, those who didn't study finance. The other thing is, of course, is you have like 80% or so in cash. Well, you put that in government papers, and you had a great interest on that, which of course you got management fee. You got performance fee on that as well. Now in these levels, that's all gone, of course. It's going to be gone for decades. US interests are at least a little bit. I mean, we're much closer to zero over here in my part of the world. Yeah, I mean, that's one thing. The easing is one thing. The other thing that we hate on the systematic side is surprise government interventions of any kind. Predictable interventions are just fine, but I see more of the problem where we end up in a binary risk situation where we're all looking at this one event. It happens from time to time. Everything is depending on one event, whether it's some budget decision, some debt ceiling, or whatever it is. And when the decision comes out, it's a binary, a lot up, a lot down, just waiting for single events. That's something we generally hate in the industry. It was worse a few years ago, but yeah, long answer to a short question, sorry.
I'll take the conversation more specific to trend following now, because you started with managed futures, and that's when you wrote the book. So what, at a bare bone level, what exactly was the strategy? What kind of assets were you trading under it? And if you could give me a sense of that.
Sure. So trend following is a very old type of strategy. What most people, not most people, that's a wrong term, say, what many people who are not in the industry, who are outside or students or hobby traders, what they do, that's a big mistake, is they do trend following on like one instrument. What's the best way of trend following? The Nasdaq, for instance. Yeah, that's not a great strategy. What we do in the industry is we trade a lot of things, usually 50 to 100 different futures contracts, covering stocks, bonds, currencies, commodities, pretty much anything you can trade with futures. And we don't care what it is. It's just math to us. The thing is, you want to have things that are not highly correlated, even negatively correlated. And we run fairly simple math on when to go in, when to go out. Everybody knows the basics of this. I mean, the proverbial devil is in the details, but everybody knows the gist of the math. It's not that complicated.
But when you started, was it moving averages or breakouts? So what exactly?
Yeah, it's combinations of those kind of things. I mean, you can make it a little bit more complicated, but in the end, that's not going to make the bigger difference. In the end, the bigger difference is how you build a portfolio. I mean, measuring trends, you can measure trends many different ways. Is it better to use a breakout or a moving average or this or that? It's an irrelevant conversation. That's not, you can tweak a little bit on those kind of things. In the industry, most of the time, we don't use classical technical analysis indicators, mostly because you have some mathematical properties on other things that make them more convenient. The technical indicators are good enough for many things, but keep in mind that many of the famous technical indicators, they were built by smart people, but back in the day when they didn't have computer resources. Many of them are built in a simplified way to make it easier to calculate them with pen and paper. And there's no reason to follow this because famous person X did this in the 70s. Yeah, if he had proper computer systems, he would have done it differently. So why are we copying the stuff he did with pen and paper back then? The bigger thing really is not the trading rules per se. They're important, but the bigger thing is portfolio composition. What are you including in your trading universe? How are you constructing the portfolio? How do the different markets interact with each other? How much risk do you put in each? These are much more important.
Talking about managed futures, what part of your portfolio today is trend following?
As a regulated asset manager, I can't give you a number, of course, but these days I don't trade managed futures myself. I allocate to managed futures funds for those mandates. I trade more on the equity side at the moment, especially for my American company. But the thing is, and that's, I'm guessing your follow-up question, that's the usual one, that why don't I trade managed futures anymore? Well, the industry is not fun anymore. You see, when I started trading this, it was easy. And I'm not talking about easy from a trading perspective. That's also missing the point by a lot of people who've never been in the industry. They look only as easy trading or not. That's not the point. The thing is, it was easier running and managing a business in that area. Because, I mean, say back in 2006, 7, even 8, 9, you can go out and talk to institutions about this trend following thing. You explain the ideas of trend following and, their eyes light up and they think it's a really cool thing. You explain all the details and they think, great, let's allocate to this. Nowadays it's become commoditized, pun intended. All the money, the money started flowing into the larger players. Everybody knows what it is. It's no longer a novelty thing. And nowadays it's much more about brand management. The fees have gone down, pressure on the fees. The costs of especially compliance have gone up. So it's much more brand management, much more than trading. If you want to start a managed futures fund, it's like, I'm repeating something I'm sure some of viewers have heard me say before. It's a little bit like, let's say you invented a slightly better toothpaste. Now what? Are you going to go compete with Colgate? Which supermarkets are you going to go talk to? How are you going to get to the buyers of the supermarket? How are you going to get shelf space? How many ads do you want on the Super Bowl? It's become brand management. Nobody cares. If your toothpaste is 5% better than Colgate, who cares? How many hundreds of millions are you going to spend on marketing, brand management? And that makes it less interesting. So either you become a large player or join a large player, or you find a different niche.
I know I'm going off track a bit here.
Mm-hmm. Sure.
Those who became big, what was in it because of which they became big?
Yeah, go ask David Harding, those guys.
Was it luck or was it,
No. No. I mean, I would say in any type of success, there is always a luck factor. It doesn't mean that luck is the determining thing. It's like, I don't know. So you want to be a rock star singer. Maybe 500 people were good enough, and 2 people became superstars. So first you need to be good enough to be in the game, but then probably a little bit of luck to take advantage of it. But it doesn't mean that somebody who's not competent will not be in the game to begin with. No, it's asset racing, and what Winton has, I haven't kept track for a while, but David Harding with Winton probably has 40 billion, 50 billion. It's been a while since I checked the AUM, but it's a whole different company. And then you're running a proper corporation with hundreds of people, and it's a whole different industry. Not everybody has the interest of doing that as well. It's a different type of business.
Got it. And that's what is happening, is what you're saying, that smaller players are finding it hard to compete with larger players, and the cost of compliance is going up and adding up.
I mean, when I started, it's funny the difference, how much this has changed. Back in the day, like 2005 kind of thing, there was not much compliance as long as you paid your tax. You had you set up a fund company in the BVI, you set up a management company in the Caymans, and have a local advisory company where you get your revenue in the end, and you pay your tax, and you only deal with high net worth individuals, qualified investors, and so on. And there was very little stuff going on then. Nowadays, quite a different compliance and company structure that is required before you even start these days.
So back to trend following. I mean, I understand that you don't do it yourself, but you allocate it to funds. But then going back to more, basic questions about it, other than diversification and managing sizing, is there anything more to it in terms of making a robust trend following system, or that's pretty much it? These are the kind of levers that you play with.
Yeah, that's pretty much it. I mean, the key is really in the portfolio interaction. Anytime you enter a trade, it doesn't matter if that trade is profitable or not. That's also something that people don't realize until they spend some time in the business, that it's not about the individual trade. It's like the stupid metaphor about trees in the forest. If you focus too much on the trees, you're missing the forest. All that matters is what the portfolio does as an aggregate. And sometimes you might even include things that probably doesn't make much money in the end, because it improves like the skew, as in, I shouldn't bore people too much with the math, but essentially you can improve the return profile of the portfolio by having markets included which are not really making money. Basically, it's a matter of when do they gain and when do they lose. So you can achieve a better risk-adjusted performance sometimes by having a loss-making instrument included in your portfolio.
Talking about trend following, there are 2 parts to this question. One is your view on this asset class, which is cryptocurrencies, Bitcoin, and the funds where you allocate, especially trend following. Do they have any exposure to crypto? And
no, not really. I mean, opening a can of worms here. I have a price target on Bitcoin. I had the same price target for the past, 13, 14 years or something since I've been following this thing. My price target is what we call in the industry a donut. That's pretty much what it's worth. Clearly there is not a single real use case for either Bitcoin or blockchain or board monkey pictures or whatever the latest meta this, and I don't know. We invent new words every few weeks too.
NFT is what you're referring to. Yeah.
Yeah. I mean, every now and then they invent new words to pretend that there's some innovation, and in the end it turns out to be a variant of the same scam. All of these years we still have no actual real world use case. This is speculation of, maybe one day all the governments in the world just give up and say, yes, you people were right. We need we need this money laundering tool as our currency, and we should give up our monetary policy. And come on, this is nothing. It's all based on the whole idea that somebody out there made a lot of money, and I would be angry if I don't make any too, so I better go in a little bit. There's nothing to it. So I mean, apart from money laundering and these kind of things, I don't see a use for it, and that extends to blockchain. I mean, every time I hear somebody saying that blockchain is going to save democracy by, I don't know. Every time I speak to somebody into this, they come up with a new creative way of claiming they can do something, and in the end, you say, well, what's wrong with existing tools? Nobody in the world ever started by saying, we have a problem. What kind of solutions do we have? And say, oh, blockchain fix. It's the other way around. You start with, we have a blockchain, we desperately need a use case.
So we have a tool and we're trying to look for a
And in
nail.
the end, you realize that if we are happy with having a slower, more expensive tool, then fine, maybe we can retrofit blockchain. But no, that's, okay, that's one part of my view. The other is this, that I've had this conversation with a lot of people many times over the past, over a decade. And one view I do accept is that, as somebody once put to me, somebody I respect in the industry who's got a proper trading background, once told me that as a professional trader, you want to trade stupid money. You don't want to trade the best, you want to trade the stupid people. And where else in the world, where else, anywhere, can you find as much stupid money as in Bitcoin? So as long as you don't actually believe the whole nonsense spiel about, changing the world and currency this or commodity this or whatever it's called these days, whatever the use case of the day is that changes with every month, right? If you don't believe any of this, the religious nonsense around around blockchain and crypto and all this, and you just want to trade stupid money, sure, don't hold it for too long. If you see it as a trade, as something you can trade, something that's probably driven by herd mentality more than, because we have no fundamentals, right? There's no fundamentals involved. It's just psychology. Fundamental is value 0, so it's all a matter of psychology. So therefore, you have trends. If that's what you do, fine, trade it. Just don't fall for the story. There's still money in it. You can still make money from it if you want to make money from it. Just don't believe the propaganda.
That's how I look at it. So long as it is a time series, and if you can kind of work with that time series and make some money out of it, why not? Without really getting too much into it.
Yep. From that point of view, yes. That point of view, I can understand it.
Makes sense. Cool. So my next question to you is, how did this transition? Because as far as I know, you wrote the book on trend following first, and then came the book Stocks on the Move. So tell me the story. How did that happen?
Right. That's actually quite a fun one. After I wrote the first book, obviously anybody writing their first book, unless you're crazy, you don't think it's going to be noticed, going to be anything big. I didn't expect this book to be well known. I was as surprised as anybody that the book really took off, got translated all over the world and sold quite well. So, suddenly you get a bunch of attention you hadn't expected. Now, as it turned out, in one of these kind of interviews, a podcast or something, I can't even remember where it was, but apparently I was asked about if trend following works on stocks. And I'm not sure if I explained myself well, but apparently I said that no, it does not. And a few weeks later or a few months, or sometime later, I hear that somebody's talking about this guy in Switzerland doesn't understand stocks and trend following, and they completely misunderstood what I tried to say anyway, and they were laughing at my lack of understanding of that. So I figured, I don't go and debate with people like this, but let's write a book and explain myself. So, because I've been doing a lot of stocks as well. Now, what I try to do with that book is explain the difference between trend following and momentum. They're quite related.
Yeah, but they're not the same.
They're not the same, not in my view. Okay, I'm splitting hairs here. I am pushing this divide because I'm trying to make people understand the difference. If you want to call momentum trend following, fine. But, I keep it apart because I'm trying to teach people here. Now, the reason that trend following, as in what we do on futures, do not work on stocks is two things. One is you have extreme correlation. Everything is beta. You're trading beta, basically. You're long beta, you're not long beta. That's the stocks for you, right? They all correlate. Some stocks go up more than others in a normal market, but once things go bad, they all
go down together.
Yeah. So you have an extremely different risk profile. You don't have the cover of diversification that you have in futures. The other thing is that in futures, everything is depending on the fact that we have extreme leverage or possibility of extreme leverage. People will be shocked to how leveraged we are on that side. But that's normal. As long as you handle your risks, that's normal. Now in stocks, leverage is extremely expensive and extremely dangerous. So you cannot play the same game. But there is something very related called momentum, so I wanted to write a book about momentum and how that works. As long as you understand the difference, both are fine, but they're not the same.
Was there, this idea of momentum? Did you read up about it, or what influenced you to kind of spend more time on it?
I had been working with it for quite some time. When I wrote that, I was running a hedge fund based on single stock momentum. Fun enough, that was, I'm getting old, 12, 13 years ago. And I'm still running a variation of the strategy. It's actually been doing extremely well for compliance reasons. I have to be careful with saying too much on numbers and things, but we've just seen the best performance, I think, in my career, the last 4 months on equity momentum. It's been absolutely insane lately, the kind of returns we've been seeing on that side. So, I mean, this is something I've been working on for some time, and I already had my own way of measuring momentum. So I figured I'd write a book and publish that.
Okay, I'm kind of going to get into details here. So when you started writing about momentum, did you backtest any existing ideas which were done in the US and you figured out you could do it better the way, for example, there were these initial academics, Jagdish and Titman, who wrote about it. So compared to their ideas, did you see you could do better, or what exactly was your thinking at that point of time?
I mean, I was already doing it my way. I read all of these things as well, but often, I mean, these are clever guys, but usually these kind of white papers are a bit too academic for my own taste. I look for pragmatic solutions that are often quite different from more academic side. I mean, it's always appreciated when these papers are published. There's always interesting insights from them. I read a lot of these things. I read most of these kind of papers on the subject. But I had my own different way of measuring it, and a way I thought would make sense. So first, I've been doing it for a while. I had my own backtesting tools. There's an advantage of having some IT background. I think there's a large number of very bad tools for backtesting, especially those available to the general retail, and particularly to those who are not technically inclined. Most of them I would never recommend anybody to touch. But yeah, you got to build yourself and figure out yourself, which leads to my general advice to anybody in the industry: learn programming. Of course, programming is changing a little bit recently with nowadays everything is Cloud Code CLI or Gemini CLI, and you work in plain text. As we've seen a lot on the internet, I guess everybody has seen it. You still need to understand programming. You still need to know programming to use these tools. Otherwise, garbage in, garbage out. But still, you do need to understand programming in this business, or you're going to be very helpless.
Got it. So going back to momentum and stocks. So if you were to write stocks on the move again today, what would be different?
Well, I mean, given that model has done extremely well for the past over a decade since the book has been published, I think it's quite well. I mean, keep in mind that when I write my books, I never try to explain an actual production system, like this is what I'm doing, this is exactly how you should trade. That's not the purpose of my books. The purpose of my books is always to design a somewhat simplified model, not to hide something. It's not a matter of secrets. I want to teach a concept. So I design trading rules that isolate a phenomenon, and I try to use it as a teaching tool to get you to understand how this works. This is a way of learning from the books. And also another reason I do that is that I find it annoying when trading books make claims that they don't back up. I mean, if they show a graph, this would have made, 50% a year. Yeah, how do I know that? You didn't even publish your rules. So therefore, I make a point in my books to put all the rules in there. Again, it's not supposed to be production models, but it's proper, realistic testing, proper methodology, proper rules. All the math is in there. You don't believe what I write? Well, the data is in there. The rules are in there. Go do your homework. Go replicate it, which is always quite fun. After I write a book, I usually get a bunch of emails from people who say that you said that this would compound at 15.7%. I only get 15.5%. Well, cool. You're close. I mean, there's a rounding error. So it's always cool to see that people actually do the math and figure out how to build it, how to test it. That's how you learn.
I understand that's the whole intention of writing the book. But then just to double click on this idea, from your book to an implemented system, what are the things which would be different in a real system? Or what are those things which a trader or an investor who is consuming that book or reading that book should pay attention to when they are converting it into a real system?
First is how you think about the real system, or real model here. Now, this is a part that's sometimes very difficult to explain to. It would have been difficult to explain to myself as well. When I was, 25 years ago, I would have struggled with this concept as well. But it's never a matter of the best possible rules, the best possible system, the most profit. That's not how you build a professional trading strategy. In the end, we build products. We build products for a reason. We build products for an audience. It's not a matter of the best, the highest and fastest. I mean, the stupid metaphor here is imagine your biggest interest is cars. So you want to build a car. You want to construct a new car, right? Since you love cars, you're thinking, I want to have the fastest car in the world. So now you spend all your research on making the fastest possible car in the world. Then you end up with, I guess, the car from my original country, the Koenigsegg. I believe that's still the fastest sports car in the world, or the most horsepower or something. It's a crazy car. That might not be the best business strategy. I mean, who's your customer here? A couple of Saudis? Who's going to buy that car? There's not many people in the world. You might be better off trying to design a Toyota or a Kia. That's where the money is. We're building products. And the whole idea of let's maximize for the highest possible return per year. Yeah, you know where you get the highest return per year? Las Vegas. You also get the highest risk in the world, but go there, put everything on 17 and spin the roulette wheel and see what happens. That's not how we do things. So, giving the long answer, what will you do to make it your own system? First, you need to figure out what are you looking for. And to make money is not an answer. Then you got more research to do if that's your answer. You need to figure out where you fit in the ecosystem. What exactly do you want to do? What kind of structure do you have? What kind of setup do you have? How often do you want to trade? Who's your competitor? How are you going to raise money for it? I'm assuming you're raising money. As I said many times, trading your own money for a living is a bad idea for all kinds of reasons. So you need to figure out, it's a personal thing. So even if I would publish the exact rules, and frankly, often the difference between a production model that's deployed and the books, it's not the kind of thing you think. It's not like, oh, I use a 5-day setting instead of a 7-day setting and I trick them. That's not how it works. It's more the details. You need so much redundancy, so much fail-safes and details on this side. It would be incredibly boring to write a book about and to read it.
How does crowding as an idea fit in with momentum investing? So with more people following momentum, do you think the edge kind of fades away? What is your thought on that?
Not really. My instinct would say it's the other way around. But everybody's always been saying for so many years that people are saying either strategies only work because everybody follows it, or they say it only works because nobody knows about it. And both can't be true. So, I don't think so. First of all, trend following and momentum are both very much human nature. That's not really going to change. We as a species, we don't change that much. And the fact that everybody follows it, that's what creates it. Arguably, the S&P 500 is a momentum index. Why are those stocks in the index? Because the price went up. And once they were included in the index, the price went up further because they were in the index. The biggest stocks in the index are those that have biggest weights, and they got there by increasing their price because their market cap weighted. Yeah, and right now we have had incredible trends on the broader AI theme, storage and computation, these kind of things. It's an ongoing theme. It's been going on like this for as long as I've been around anyway, probably a lot further. I don't see a reason for that to stop. Keep in mind, of course, momentum doesn't work all the time. Like right now, we had an incredible run. Maybe it continues a while longer. And then we probably have a period where it either underperforms or it keeps up with the markets and gets boring. And then sooner or later, it's going to spike up again.
So we were talking about momentum, especially in 2025 and the situation right now where, because of be it Trump tantrums or whatever you want to call it, there was so much of volatility. How did your momentum model handle it? And are there, situations like these where momentum doesn't work, even though your larger system may be on because it's way above, let's say, the moving average, or your regime is still, risk is on, but because of volatility, the system doesn't work. So have you experienced something like that?
Oh, yes, of course. Last year was a very, very good year, despite all of this. Now, again, this is a matter of preference rather than right or wrong, but my preference is not to respond to short-term volatility, not for equity momentum models. It's too high risk going back and forth. So I don't want to respond to a very sharp drop, for instance, like we saw last year. There was the initial tariff shock when the tariffs were announced, and there was Q1 last year or early Q2. We had a larger sharp drop that was very quickly recovered. There's an initial shock. Those things, in my personal preference, is to leave it, because more often than not, we get a bounce back up. What you should keep in mind, of course, is that equity momentum does not work well in a prolonged bear market. And that's the problem with most momentum products. They don't know how to do any sort of downside protection. In all fairness, for a large institution, it's a difficult sell internally and to users or to customers that you shift allocation. It's not a common thing to do, to shift the exposure during those times. I do that. I build that in. So I use for the money we're managing, especially now for our new high net worth product for my American company, the Hush Club high net worth offering that we launched quite recently. We did extremely well on that one so far. And that one, we have a built-in downside protection. We start scaling out of the markets when we see a pattern that the markets start getting shaky, when we don't think it's good for momentum. As I said, momentum works great in normal markets. But once there's fear out there, everything falls. Everything falls. The momentum stocks tend to fall more than the rest.
So this downside protection, one of the ways in which you describe it in your book is by having a moving average kind of a filter on the benchmark indexes, something like S&P 500. Are there other such regime filters which you have explored which work?
Oh yeah, of course. As I said, I always simplify this in the books. Using something like the S&P the simple moving average of the S&P 500, something like this, it's actually it's not bad. I mean, it's simplistic. That's usually not the detailed rule that we implement in the business in the end, but it's kind of good enough. That actually works. I mean, you can do multiple ways. You can look at volatility, for instance. That's a more common way. Look at market volatility. You can look at dispersion. You can look at the momentum patterns of the stocks constituent in the index. There are multiple ways of doing the same thing. The most critical thing is you just need a way to identify when the markets are starting to look unhealthy. And I'm personally not a fan of binary on and off switch, as in sell everything and rebuy everything. That's a big risk in that. I'd rather build something that slowly scales down. You might also, slowly scales up. One thing I worked with in the past as well is to measure the extreme. You scale out, but in the end where things start looking really horrible, that's when you want to start buying a little bit. Maybe not full on, but you start scaling in when everything looks extremely bad.
Got it. Any other indicators like market breadth or anything else that has you explored and either have found it useful or you have rejected them because they don't make sense?
I probably explored almost everything over the years. I mean, sometimes out of curiosity and sometimes because I'm, some things I spent a lot of time researching because I was doing some speech at a conference or something and needed a fun research project. I used to build very complicated things like 20 years ago. The older I get, the more I realize that simplicity gets the job done and is usually more stable. But yeah, sure. Sometimes I do something for fun. Like a couple of years ago, I was doing a speech at a big conference for the CMT organization, the Technical Analysis Organization in the US. So I figured I need to do something fun for them. So I did a deep dive into point and figure, tried to analyze what's wrong with point and figure, the reasons why traditional point and figure makes no sense to me. And then I changed point and figure in a way that does make sense, as it is mathematically nonsensical in its original form. But I did some research on how you could first fix it. It's primarily to do with the box sizing that does not make mathematical sense if you dig into it. But there are ways of fixing it. And then I built my own point and figure backtest engine. Just for fun. I just wanted to see what can be done. In the end, my conclusion was that point and figure actually works quite well, almost as well as the existing much simpler tools that I have. Meaning that, yeah, it's fine, but Occam's razor. In the end, if you can accomplish the same thing with simpler tools, use simpler tools.
Back to the question, any other regime filters other than 200-day moving averages that you think could be used?
Sure. There are many different variants. I usually work with combination volatility-based filters to begin with. Measure volatility. That's a great indicator. You can work with, say, dispersion measurements of momentum.
So when you say volatility, you mean volatility of the portfolio or individual stocks and then kind of position sizing accordingly, or what exactly are you trying to?
I would look at volatility of the overall market. Because volatility of your portfolio is always going to be high on momentum side. I mean, that's what we're doing here. I mean, don't forget that we are just loading up beta. That's what we're doing. It's not rocket science. We're just figuring out where the beta is worth taking, and we're loading up a lot of beta. So we'll have a high vol portfolio either way. No, I would measure vola on the overall markets. I would also look at the pattern of the overall momentum of the individual stocks in the index. Once we start seeing that the momentum in general is dropping way too low on large number of stocks, warning signs, and you can have multiple indicators or analytics, if you will, that kind of vote together and come up with different regimes. And you have to define what the regimes are, like discrete, whether fixed steps or discrete steps or continuous steps, and where you adapt the exposure accordingly.
Got it. That helps. Coming back to now, we spoke about trend following, and then you moved to momentum investing. Both are in a way about catching trend at a broad level. So have you looked at, I'm sure you have, but your view on mean reversion strategies, which means, counter trend strategies as a part of your larger portfolio strategies. What kind of strategies, what makes sense and what doesn't? Your thoughts on that?
So my first deployed model based on counter trend signals was born out of frustration, as counter trend models often are. I just had a tough year on the trend following side. And by the way, everybody has tough years. Anybody tells you they don't have tough years, they're either lying or never traded in the first place. It's particularly as a systematic trader, it doesn't work every year. It happens. So anyway, I had a year where you get this entry, exit, or stop out all the time. So I started designing a model based on the theory I had. The theory was that a lot of trend following companies out there, much, much larger than mine, are doing more or less the same thing, which I could kind of prove or infer by reverse engineering their track record. So in that case, I know more or less where they're stopping out. So I decided to predict where I think the large players have their stop loss. This is systematic, guys. And then I put an entry point a little bit below that. Essentially, the theory is if they all stop out at the same time, they're going to create an exaggerated move on the down move. Or if you're talking about a long position to begin with, they're going to push it down a bit further than it should be pushed down. Now I pick it up from there and I ride the bounce on a shorter term trade. That worked remarkably well. So that one I've been trading for a long time.
It still continues to be a part of your portfolio.
That one is working quite well. Yes, exactly. That was on futures. On stocks, for many reasons, I prefer a little bit longer holding periods. So I don't do that on stocks at the moment. Doesn't mean it doesn't work on stocks, but I've deployed it on futures, not on stocks.
If you look at it like this, so be it momentum, trend following, and mean reversion, how many systems at any point of time would be there as a part of the portfolio of strategies that you trade?
Yeah, I try to keep it simple, and it is a matter of what you want to achieve. Now, in theory, mathematically, you can probably achieve better risk-adjusted return by trading multiple strategies at the same time with different type, but it might not be a good business idea, depending on who you're targeting to raise money from. If you're looking to get money from, if you're trying to raise investor money from, say, smaller tickets, say from retail or lower end high net worth, if that's contradiction of terms, but if you're looking for that type of money, then maybe it's a good idea to combine different strategies. You do 5 different things, smoothing out your returns. But if you're looking for big boy money, if you're going to pitch an institution somewhere, they, in my experience, would much more prefer to have clean strategies. They want to know what they're buying. And if you go and tell them, go talk to a pension fund and tell them that I combine these 5 different strategies or different types for a smoother profile, what he's hearing then is, the CIO of this institution is hearing that this guy is trying to do my job for me. It's his job to combine strategies. It's his job to build allocation in his portfolio, not your job. He wants clean building blocks so he can construct the kind of exposure he wants. And he wants to understand what exposure he has. Not that some black box by some weird guy in Switzerland suddenly shifts from trend following to counter trend strategy because of some rule he doesn't understand. It's not a good sell. So in that case, rather create a couple of clean products and let your client decide what he wants to allocate to.
Makes sense. Going back to momentum, I had a question which I forgot to ask you. Other than US as a market, have you looked at momentum in some other markets? And how has been your experience with that?
I have a bit, yes. The problem is always the complication you add with the currency issue. Unless, of course, you have a clean strategy just in India, for instance. I have not looked at the Indian market, I have to confess. But yeah, make me an offer and I'll have a look.
Sure.
No, I haven't. But I have been trading global momentum. It's been a few years ago since I used to trade based on stocks in the MSCI world rather than the US only. If you have sufficient client base or sufficient asset under management to justify it, it's fine. It adds an operational factor that can be much more work than you might expect. It looks easy in a back test, but in the end, you need to manage the whole different infrastructure, and you need to manage the currency exposure, and that can be more of an issue. You need to manage, are you hedging the exposure, or are you just leaving it open? A lot of complication there, but it does work in my experience fine. You just need sufficient universe. I mean, I wouldn't deploy, for instance, a momentum model on the Swiss market because it's too tiny. You only have a few stocks that matter and no diversification.
Got it. So you want liquid stocks and you need a whole lot of stocks where there is momentum.
Yeah, you need sufficient amount of stocks. I mean, you have enough stocks in there will be momentum somewhere. But yeah, I mean, I would absolutely love to deploy something like this on the domestic Chinese market. Unfortunately, that's not so easy from practical, operational, so on. But I think there's a massive opportunity locally, domestically in China. As a foreign asset manager, of course, I can't really reach that market, but that would have been interesting. India, I think, would be interesting as well.
Yeah, there are a lot of momentum mutual funds and individual momentum traders as well here. So we have an active community, but then the market is still small from a market cap standpoint. So, and liquidity can get thin the moment you kind of go to stocks which are beyond certain market cap. So that's a challenge that we have here in India. So coming back, the little that I have read and heard from you, this is a specific thing about retail traders, and you generally been critical of individual retail traders trading. I wanted to kind of understand where that comes from and what does it mean? Because there are a lot of retail consumers of your be it content, books, and other things. So they're trying to learn and do something on their own. So I just wanted to, I want your help to set that context here.
In which way? Or wait a minute, are you referring to my deliberate provocation where I said that trading your own money for a living is...
Yes, that's exactly what I mean.
Okay, let me explain that. Now, I think it's perfectly fine to trade your own money as a hobby. You just don't want to do it for a living. Now, the reason for that is, let's say you quit your job, you have no other income, you just live on trading your money. So you now take all the risk for a limited upside. It's bad mathematics. Now, my point with this argument is that if you modify your goal a little bit, instead of just trading your own money for a living, you trade other people's money and your own for a living. Now you have a free option. Now your upside is much higher, your downside is much lower. Now look at it this way, that some of the best people in the world, I'm talking some of the very best people in the world, have managed to compound at around 20%. Any given year, anybody can do very, very different numbers in a short run. But give it, 10, 20 years, the best people in the world have achieved 20, 22, 23%, somewhere around there. And still you have hobby traders who think, well, I can double my money every year. Yeah, maybe one year you can, but then you're going to lose it all next year. You take all the risk. Now you need to take money out because you need to pay your rent, you need to buy food and so on. So you're actually decreasing your firepower, your ability to deploy capital because you need to take out money. Now you have a bad month somewhere, you still need to take out money to live, and you're decreasing. It's a bad idea. Now what you want to do instead, and again, if you do this as a hobby, you still have a job and everything, perfectly fine. Just not the only thing you do. If you want to do this for a living as the only thing you do, you want to manage other people's money. First, it will take away the stress factor that you keep pushing for higher returns. If you just manage your own money, you probably start aiming for crazy numbers like 50% a year or something like that, right? Which is not a good idea. You aim for that high return, you have to be prepared to take an extreme amount of risk, and sooner or later you'll take a big hit. What you instead want to do is manage your own money together with other people's money. This way you have an income to begin with. You get a management fee by managing other people's money, perhaps even a performance fee if things go well. You no longer have to aim for crazy returns. because most people are perfectly fine getting 12 to 15% return. Don't aim for crazy numbers. Play for something realistic. You still get paid. Your customers are happy. You get paid. You're much safer. You can still buy your food. You pay your rent. So my point with that article, and I still remember it got a lot of attention. Like over 10 years ago, I wrote that. My point was not to say that retail traders are stupid. Not at all. My point is, if you want to do this for a living, then do it for real. Don't do it halfway.
Makes sense. Absolutely. Okay. So I have a few closing questions, and I'll get to that. One of the interesting questions which I have is, you work on both sides of both in Europe and America. Are there some fundamentally different approaches that you notice between fund managers from the US versus Europe? I know it can get a bit stereotyping kind of a thing, but then, if you notice something interesting, I would love to know.
Well, I mean, the thing is, even when I only worked in Europe, I was trading in the US mostly, doing things the American way most of the time. So it's not that different, really. I mean, I think Americans in general are more entrepreneurial minded. So it's a different way of working, a different way of risk taking on company side or personal side. In the end, I mean, it's fairly similar. I think we are a little bit more risk averse, perhaps, on this side of the pond. But not really big a difference.
Cool, got it. You have written 4 books, and writing is a lot of effort. Now, where did this whole interest in writing develop? I mean, how did it come about?
I think I wanted to write a book for many years before. I didn't feel like I had anything interesting enough to say. I think I started writing books many times. I probably started back in the 90s and draft something and back and forth, abandon, and I'm glad I did, because looking back, I think before I'd actually done real things in the market, I probably didn't have anything interesting to say anyway. So that was quite fun. I mean, it's like everything else. It's like my trading. I got lucky when I started trading, therefore it was fun. I mean, again, I was lucky because I started trading in a massive bull market. My first book, I got lucky. It sold really well, and therefore it was fun. I mean, to put in context, my publisher told me that most trading books sell around 200 to 400 copies in a lifetime of the book. Now, obviously, if you spend a lot of time writing a book and you sell 300 copies, you'd be pretty angry. I mean, it would feel like such a waste of time. There's only a few books that really take off, and the rest do nothing. So I was lucky. I was one of those that took off. Therefore, it was fun, and then I continued. Then I always wanted to write a novel, and I also felt for some time that I didn't have anything interesting enough to say. And once I had gathered enough market experience to have something interesting to say, I wrote about that. It's a hobby, really. Writing books is not something that by itself is going to produce any sort of interesting money. I mean, even if you have a global bestseller. I mean, to put into context, once we mentioned Jack Schwager before, Market Wizards guy. I got in contact with him after my first book. I got in contact with him. Obviously, he sold a lot of books over the years. Jack told me, I think it's funny coming from him, he said that as far as he knows, there is only one person in the world who can make a living selling finance books, and it's not him. So I'll leave you to figure out who that is, but only one guy. A book by that guy has been mentioned in this podcast so far, so I'll let your audience go find it.
Absolutely. One last question is, beyond markets, how does life look like for Andreas?
Stressful, a lot of travel. No, all good. I mean, my way of working changed dramatically a couple of years ago when I started my American fintech company. We launched a company where we're the first American asset manager who offer completely 100% free asset management, up to 100,000 app-based asset management, systematic based on my models. That's a very different way of working for me. We have a large number of small users. Anybody in the US can sign up for free just to download the Hush Investments app. Then we launched the high net worth, the Hush Club, based on the website, on web-based, where we are taking users with over 100,000, minimum 100,000 investments. It's a very, very different way of working in the fintech world. I'm more used to the hedge fund world where business is done quite differently. So now I'm traveling a lot all over the world with that, raising money, talking to investors. Yeah, and we are still open to take investments, both in the products and the company. For those who are interested, just contact me directly. Yeah, it's quite different. I am in airplanes quite a bit. I'm going to New York this Friday, this week. Quite a lot of things. Otherwise, yeah, I've been based here in Switzerland, in Zurich for the past 15, 17 years, something like that. 5 years in Geneva. It's, yeah, interesting times. A lot of things happening everywhere.
Got it. Thank you, Andreas. Thank you for taking time out to talk to us. And
Thank you.
Wish you all the best with Hush. And I hope all these travels that you are on to help you even more. And look forward to have you with us again sometime later.
Sounds good. Thank you very much for having me. Thank you.
Thank you, Andreas.